We keep hearing that inflation is temporary, and there's a lot out there that would make you believe that. But there's also a lot of data that would make you think that it's something else.
Inflation, as I have been saying on your program to you, Romain, is far from transitory. It has been spreading. It has been not only in the supply bottleneck related sectors, but it has also affected more broader sectors of the economy. Rents are increasing quite substantially. Home prices are up sharply, record levels. And none of this to me seems to be transitory. Now, on top of that, we have the significant increase in energy prices. And if Powell were to continue to say transitory, at the very least, he has to keep praying that this winter has to be a mild one, because otherwise you're going to see natural gas prices increasing much more on both sides of the Atlantic, and inflation rate is going to pick up. Go ahead, sorry.
No, I was going to ask, with all of those factors in play with inflation, how will that start to impact this reopening story that traders are betting on today? Doesn't it mean that some of this consumer sentiment might dampen, given they can't afford potentially many of the things they may go to market for?
Sonali, that's an excellent point. That's exactly what I believe. Despite what you have seen today in terms of consumer spending number being better than expected, it's a 1 month number. As you look forward, University of Michigan consumer sentiment has been down sharply from pre-COVID levels, and that is to a large extent due to their fear about inflation. So to the extent that dominates, and this increase in consumer spending cannot be sustained, so you're going to have some form of recovery much slower than we had in the first half. But on the other hand, inflation is going to pick up, and which is why I have been speaking on your program about the likelihood of stagflation. And stagflation, when I said that 2 months ago, did not seem so much as a reality. Today, it appears much more real than it did a couple of months back.
And you're definitely seeing more notes, more talk around the street about stagflation becoming more and more of a risk. And I'm curious, if that's what's in the offing, if we are entering a stagflationary environment, how do you position a portfolio around that?
It is a difficult one to do, because what you find is bond yields are going to go up and equity prices are going to go down under that setup. The last time we had significant amount of stagflation, Katie, was in the 1970s. And starting in 1973 and ending about 1981. And it was very hard to find anywhere to go. So how do you position yourself? You need to be very nimble. If you see an energy shortage, which is what caused the stagflation in the 1970s, if that is coming back again, you want to be in it for some period of time. You want to go more into value equities, which are likely to benefit at the cost of high tech, at the cost of growth. You probably, internationally, you want to be looking at Europe more than the United States. You want to reduce your China exposure. These are various things you can still do in a stagflationary environment.